Hello and welcome to UK Property Talk, the show that talks about property, not just in the UK, but all over the world. And today I want to talk about a quote by Robert Kiyosaki. He is the author of the book Rich Dad, Poor Dad, which is a modern day classic. I mean, some of it is a little bit dated now, but it's still it is a book that changed my way of thinking about property and assets and buying things for cash flow and using other people's money, of course. So it's a great book. But Robert Kiyosaki has said that property prices are at the top of the market. He's saying that they're all topped out. In fact, he uses the quote by talking about, he said, young people come to him now and say they've just bought their property, they've got loans and this sort of stuff. And he says, why would you buy at the top of the market? Which is significant because it's the first time I've heard him say this. Normally he's saying just buy, don't worry about it, just keep borrowing and buying. And kind of his strategy has been to borrow money throughout his last 20 years of his career and just keep taking money out of existing properties, refinancing them, in other words, and living on that money, which he calls tax-free income. Well, it is tax-free, but obviously increases your debt. But I would say his debt is probably, in the hundreds of millions of dollars, whereas most people get frightened of a $500,000 or pounds mortgage. But he has always kind of just kept buying. That's what he's told us anyway. We don't know what these people do in reality, but the advice they were giving out is just buying. It's the first time I've heard him say that the property prices are at the top of the market. So maybe it's a time to just be a little bit more careful. And obviously this comes at a time when there's a lot going on in the world. We've had 2 years of chaos. We've got a war going on, maybe this is why one of the reasons why he's urging caution. But Robert also thinks that we're also already in a recession and we could be heading into a depression. So this is only one opinion. I was at a London event where I met Robert Kiyosaki, and at that time it was when the BP oil spillage happened, and it was off the Gulf of Mexico, I think. And anyway, this BP oil spillage took place, and the American government was suing BP for billions, even though it was an American contractor that actually did the work and caused the problem. But BP was sued because it was like an anti-British thing, I think. And he said, BP are toast, they're going down, no one else survived this, they're toast. And I didn't think that at the time, because he thought that BP, I think he was shorting the shares. He thought BP was going down the toilet. He said, they're toast, BP's gone down the toilet, that sort of stuff. And I didn't believe it at the time. It didn't happen. BP is still there, still one of the leading British companies on the FTSE 100. So he doesn't get it right all of the time. And he's a great guy, he's a great speaker and all that sort of stuff. But this is one very pessimistic view. And, whether we're officially we're not in a recession, but of course a lot of people are already in recession in their own economy. But it takes 2 quarters of negative growth to become official as a recession. But I want to stress this is only one opinion. It's an extremely pessimistic view. And it could come to pass. It could be that there's a property crash coming, but it all depends on this, what governments do, what governments and central banks do in the next few years to combat, the war, the food shortages, inflation, higher interest rates. What the governments do in the next few years will determine where we are going in this game. It's a bit like a game of chess, right? The game of chess has, multiple million of possible moves that, in this case, the players will be the central governments, the central banks, and depending on the moves they make on the chessboard, it could change the whole outcome of the game. The game's not over yet. The game is continuously running. That's my take on it. That's my analogy. For instance, the Federal Reserve now are introducing tightening up measures to cool down the economy, to curb inflation. This means that they will be reducing spending, and this is going to hit many families. You might think, well, what if the government reduces spending? But a lot of the business done in the world, in the UK and America, is fueled by government spending. The government brings in this contract, whether it's a new railroad or like HS2, the Elizabeth line, that's created tens of thousands of jobs, and HS2 is still creating jobs. Obviously it's on borrowed money and we've got to pay for it at some time, But in the meantime, it keeps workers employed and gainfully employed, and then they're earning money, they're paying taxes, they're spending money, and we are a spending economy. So as they spend more money, the money spreads out through the rest of the economy. That's the way things are done. Now, if the government starts tightening things and not spending the money, then the economy goes into recession. I saw this during the Thatcher government when they cut government spending, and I was meeting clients when I was a financial advisor that said they've lost their contract to do this job and that job, and this local authority has cancelled the contract to do this and that. So it has an impact on everybody, and this is what the US Federal Reserve, and these measures could drive the country into recession. We know that the ECB, for instance, the European Central Bank, has warned that there could be a housing correction and even banks could be at risk of defaulting. So there's no doubt what's caused inflation in my mind. It's not just the war, although that's not helped, but it's the printing of money on an industrial scale since the last Great Recession, 2008, and the financial crisis. And this is obviously, people were saying it all along. If you keep printing money like they did in Germany in the 1920s, in Venezuela, in Argentina, that you will get hyperinflation. Now, we're not going to have the hyperinflation that Zimbabwe had, which Mugabe wrecked the economy through printing money. I think it ruined their currency. But it will happen. We've seen inflation at 40-year high, and one of the problems we had is just, it's not only that, but now that we've got the war, it's pushing up the price of wheat and food and fuel and gas, and it's hitting families really hard directly in the pocket. So we've got this inflation going on, but the price rises are higher than inflation. The cost of pasta here has already gone up by 50%, according to official estimates. Now, I've been telling people to buy these dry goods and pastas. I've stocked up on it just in case there are shortages and food shortages, because you can almost invest in pasta and it's going up by 50%. I mean, you couldn't do that in a property. Now, I can't fill my house with pasta, obviously, but it seems like I put my money into pasta, I've made 50% just by buying it last year or buying it 3 months ago. It's a ridiculous thing to think. You can't just keep buying pasta as an investment, but it just shows you that if I'd just left that money in the bank earning nothing, instead of just buying some pasta, the pasta now has gone up by 50%, as have many other things, many tin foods, many other foods. And, it's that the money in my bank would have gone down by the inflation rate, 8% in a year. The value of the spending power of that money is going down. So these commodities are going up already, and we're seeing it in the shops. Food packages are getting smaller, prices are getting bigger. So we've got the Ukraine war, we've got the money printing that's caused inflation, we've got oil and gas shortages throughout Europe. This is going to hit the European economy, including the UK. Some people are predicting we could see food shortages, we could see fuel rationing, blackouts in the winter because we're coming into summer. But again, it depends on the moves made on the chessboard, doesn't it? If the central banks take action, like one of the actions, Boris was over in Saudi Arabia recently in the Middle East. Saudi have agreed to pump more oil, so that could help to bring oil prices down. Although it hasn't happened yet, we're still seeing record prices at the pumps. But these measures could curb what's going on. But in my own view is that the West has badly miscalculated in the way it's dealt with Putin and Russia and the Ukraine war by bringing in sanctions that effectively shoot themselves in the foot. And also by stealing Putin's money and the government's money. They had their sovereign wealth fund invested in Europe, part of their sovereign wealth fund. Part of that money was used to pay for Russian goods, Russian oil, Russian gas. And now the West has effectively just seized it and stolen it. And that's not good for our reputation as a supposed safe haven to put your money. And it pushes people into things like crypto because they realize that the central banks can just grab your money at any time, and they can grab your money in your own bank account as well. If they bring in digital currency, central bank digital currencies, they will be effectively able to just sequestrate, confiscate, seize your money, just like they did in Cyprus a few years ago. So you've got to be careful, and this is not good. And now we've taken their money. We've seized yachts and this sort of thing of people that are not even in the government. That's not good. But the biggest thing I think we've shot ourselves in the foot in is sanctions that say we're not going to buy your oil and gas. That's hurting ordinary people, and it means that prices have gone through the roof, and it affects every kind of business because everybody is using a certain amount of oil and gas. And this drive for wind power and green energy is another miscalculation. But but the sanctions part of it is really hurting us, and Russia can sit back. They've planned this chess game ahead of time, and we know the Russians are good chess players, but I think they planned this chess game well ahead of time. They knew the moves that would come in, and they can sort of sit back. They can survive this. They are an autonomous country. They can survive long drawn out wars and recessions because they produce their own food and oil and gas. They've got their manufacturing base. They've got their own minerals and their own wealth that the West actually needs more than they need to sell it to the West. So they can survive. They've also got a pipeline going to China. So they can just do business with other countries. And there are other countries that have stayed friendly to the Russian economy. So I think they can sit out these sanctions for longer than the West can survive them. Germany needs Russian gas, as do many other European countries. And yet you've got the European Union saying, we're not going to buy it. We're going to block it. So I think that they're going to shoot themselves in the foot and drive these economies into recession. That's what I think. Because how can you manufacture goods without power? It's just not possible. And it's all right, these governments say we're going to have wind power, we're going to have green energy, but it's not going to happen for years. You can't just shut down production of oil in the North Sea on the basis that there'll be wind power there. It's just a load of rubbish, to be honest, in my opinion. So how will this affect property in general? Well, actually in inflationary times, property values have gone up in the past. I remember in the 70s and 80s, when you had high inflation, properties was going and investments were going up very fast. But of course, the inflationary pressures meant that the money was being devalued anyway. But assets such as property tended to go up. But if we have a situation where people have got less money in their pockets because of a recession, they've got less money in their pockets because they are spending so much money on food and electricity and gas, which have doubled in price here in the UK, then obviously that will affect how much money they've got to spend and invest in the stock market and in property. And higher interest rates, which are coming and have already started to arrive, will affect people's ability to buy the property at the prices that they've been offered at. We've seen in the last couple of years with very low interest rates that property prices were pushed up even as they were being sold. They were putting people on waiting lists and saying, well, I'm not going to accept the asking price. I want a higher than asking price. And they would have a kind of a bidding war going on during the sale process, which is very unusual. So it's definitely a seller's market. But things could be changing because now if we get a situation where higher interest rates has pushed up the affordability level, and we know that affordability is like in double figures already, but the affordability level is changed by the interest rate on the mortgage. Mortgage rates have gone up in the UK and in the US. So that affects people's ability to borrow the amount they want, because the lenders now say, well, we're bringing in new rules. The higher interest rates will affect how much you can borrow, certainly how much you can pay as well, because if it pushes you over your budget, you can't do it. So you're going to have to go back to the buyer and say, well, I can't get that level of mortgage. And that will automatically push down the prices. So you can see how higher interest rates will affect people's ability to pay these top prices that they've been paying up to now. And maybe this is why Robert Kiyosaki is saying the market is all topped out. So we'll have to see how it works out. Of course, we just don't know what will happen in reality, because it depends on how the game is played out. And even economists get it wrong. I met an economist once that about 10 or 15 years ago, he calculated in his own economic way that the prices in London would go down and the prices in the countryside would go up of property. So he sold his London house, and moved out to Somerset in the West Country. And since then, prices have gone up a bit in Somerset, but the prices in London have rocketed. And he said now his wife always drives past that house and says, this was our house that we can no longer afford. So economists, and he was a property economist, he got it wrong. I've had other property economists tell me that the market was played out about 15 years ago, and yet it's kept going up. He was selling his properties in Docklands. So we just don't know what will happen. You've just got to be careful. In general, during times of inflation, during times of problems, you're better off having your money in assets rather than in cash. Cash is effectively trash when it comes to the inflation rate, the amount you earn on cash. So you generally are better off having your money in an asset such as property. Gold, it can go up or down, gold, but property is something that's used by people. There's always going to be a need for property, and there's still a shortage of property in the UK, so there will be a need for it. But maybe it's wise to wait a little bit longer to see what happens to prices, because the market certainly is at an all-time high. It keeps reaching that all-time high every month. So I would be a little bit careful. Now, I wanted to also talk about auction, buying and selling at auctions, because it is a very different animal from the usual way people buy property through a high street estate agent. Buying at auction is equivalent to the Wild West compared to a normal estate agent, but they do have their rules, but you've got to understand the rules of the game. So what are the rules? Well, here are some of the main differences. When you go into an auction and bid for something, you are committed. If your offer is accepted, you are committed to buying, and you've exchanged contracts. When you buy through an estate agent, you say, I'll put an offer in for that property, then it goes back and forth, and they say, well, your offer is accepted. And usually you've got 6 to 8 weeks to exchange contracts, in which time you can do your research, you can have your mortgage arranged, you can have surveys done, and at any time you can pull out and the buyer can pull out. But in an auction, you're making that commitment. When you buy and go into an auction and buy, or you sell and the hammer goes down, you are committed to buying, and the seller is committed to selling. And there are penalties if you don't come up with the money. So you've got to have your money already there. So in other words, when the hammer goes down, if you've seen on these shows, sold to the man at the back for 200,000, that is sold. And some auctions require you to put down a deposit before you go into the auction. Some of the online ones certainly want a credit card, so you can't wriggle out of it and disappear out the back of the room. But some auctions I've been to, people are not required even to register, and they just put their hand up and bid for properties that they haven't even seen, they haven't done their research on. So you've got to, you really got to do your homework here. You've got to read the legal pack, which is produced before the property goes to auction, and make sure that you've got the right legal right for this. There's no problems with the title, because properties are sold at auctions that have defective titles. Properties are sold at auctions that you would never sell in an estate agent. So I've seen properties sell at auctions with a limited legal pack that I think had that fire risk cladding still on it, and nothing was said about it in the legal pack, but it's sold, and the new owner will have to deal with that. He might have a bill of £20,000-30,000 per apartment to remove that stuff, or he might have extra costs for security. So you've got to be very careful. You've got to do your homework with the legal pack, which means either you reading it or getting your solicitor to read it. Then you've got to do your survey, which is very important, because there are a lot of properties going to auction which have structural defects, structural problems, and this is where they're sold at auction, because they know that they'll be bought by dealers who can handle that situation and calculate the cost of it and build that into the price. Fees are usually higher at auction. You typically pay a fee to sell at auction of 3-4%. In some auctions, the buyer is paying the fee at 3%, so you've got to watch that as well. The auctioneer I recommend and deal with for sellers is that the sellers don't pay the fee, the buyer pays the fee, and that's an interesting twist. But there are opportunities, definitely opportunities at auction to pick up cheap properties, to pick up the sort of scruffy, dirty properties that nobody wants to buy, that need work. This is the place to buy them, and properties, sometimes they're genuine sales. They could be not selling because there's a defect, but selling because a housing association is selling off 5 or 6 properties, or an authority, local authority, or a police authority selling off ex-police houses. So they can be genuine reasons why they just want to put it in the auction, get it sold, because they don't want to deal with buyers coming back and forward and messing around and then pulling out. They just want to get it sold. Probate, where someone's died, is another way. Another traditional method is sold through auctions on a probate sale. But it's a question of buyer beware. Definitely buyer beware. I can't remember the Latin term for it, but there's a saying of buyer beware, because when you go in, you're in that pit, that merciless pit called an auction. And there are online auctions now as well, so you've got to be very, very careful in an auction, but there are fantastic opportunities still there. Do your homework, learn how it works. This is a course in itself, really, buying and selling at auctions. My own agency will be offering, my own estate agency, Open House, will offer both. We offer high street sales and online auctions as well, with no fees to the seller. Now, I just want to talk about one more thing, in that if you want to learn more about property, I do personal mentoring as well, but if you want to just join a free course, there's one on next Wednesday, Property Investing Secrets, run by an expert, not by me, who will be taking you through the basics of buying property, investing in property. You should never go out and invest in property without learning how it works, because you'll probably buy the wrong thing at the wrong time and it will go wrong. But do the free courses. There's one on next Wednesday. I'll put a link up to that very shortly, and good luck to that. If you want to join me live every Saturday morning, I wasn't running it live yesterday because I was away, but if you do want to join live every Saturday morning, I'll put a Zoom link where you can register for that every weekend and join in the discussion. So thanks for listening today. If you've got any questions, do put them in the comments. I do respond to comments, I always like to hear your views, whether you're for me or against me. I don't mind, but do put things in the comments. And thanks for joining me. I'll be putting this up on my YouTube channel as well, which is Charles Kelly Money Tips Podcast. So do have a look at that as well. So thanks for listening. And remember, if you're buying at auction, it's buyer beware. And don't forget that free training on Wednesday evening, Wednesday the 8th at 7 p.m. I'll put a link up for that as well. Thanks for listening and have a great day. Bye for now.